Gross profit margin, the first truth filter. Two companies sell the same product, same revenue, same market. One becomes a long-term winner. The other keeps struggling despite growth. The difference isn't luck. It isn't marketing. It's gross profit margin. Revenue can lie. Margins don't. Gross profit margin tells you one fundamental thing: how much money a company keeps after producing what it sells. Before salaries, before marketing, before rent, interest, or expansion. It measures the strength of the product itself. If this is weak, everything built on top of it becomes fragile. Here's the formula, and keep it simple. Gross profit margin equals revenue minus cost of goods sold divided by revenue. In plain words, if a company sells something for 100 rupees and it costs 60 rupees to make, 40 rupees is gross profit. That 40 rupees is the fuel for everything that follows. Now, an important clarification. Cost of goods sold includes only direct costs, raw materials, manufacturing or production, direct labor. It does not include marketing, corporate salaries, rent, interest, or taxes. Those come later. This distinction matters because gross margin isolates the product economics, not management style. Let's look at a real comparison. Company A generates 100 rupees in revenue. Its cost of making the product is 85 rupees. Its gross margin is 15%. Company B also generates 100 rupees in revenue, but its cost is only 50 rupees. Its gross margin is 50%. Same sales, very different realities. Company B can survive discount wars. Company A cannot. Company B can absorb shocks. Company A lives on thin ice. Margins decide who survives pressure. Now, a critical point. There is no universal good gross margin. Margins only make sense within the same industry. Retail and FMCG businesses often operate between 20 and 40%. Manufacturing businesses may run between 15 and 30%. Software and platform businesses can reach 60 to 90%. Comparing margins across industries is meaningless. Comparing them within an industry is powerful. This is why the world's best investors start here. Warren Buffett looks for businesses with pricing power, and pricing power reveals itself first in gross margins. Peter Lynch avoided low-margin businesses because even a small mistake can erase profits entirely. High margins give flexibility. Low margins remove it. A strong gross margin usually signals three things. First, control over pricing. Second, resilience during bad years. Third, the ability to reinvest without excessive debt. A weak gross margin signals the opposite. One raw material shock, one price war, one bad quarter, and the business starts bleeding. Now here's where many investors, even experienced ones, slip. They focus on revenue growth, they focus on profit growth, but they ignore margin trends. Margins can quietly decline while profits still rise. That usually means competition is increasing, cost pressure is rising, or pricing power is weakening. Growth without margin stability is not strength. One more important distinction. Gross margin shows product strength. Operating margin shows business efficiency. A company can have a strong product and still run a poor operation. That's why gross margin always comes first. Without a strong base, efficiency has limits. So before you check net profit, before you check valuation, before you check ratios like PE or ROE, always start here. Gross profit margin. It is the first truth filter in investing. In the next video, we'll break down operating margin versus net margin and explain why most investors misread profitability there. Follow for smarter investing.